Reading the market tea leaves for worldwide recession risks. London, the quickest rate hiking cycle in decades and inflation nearing double digits has given buyers scouring market moves and statistics to gauge whether or not the arena financial system is headed for recession. Business interest is slowing. Many stock indexes are in bear territory, while higher borrowing fees are squeezing corporate and purchaser spending. The U.S. Federal Reserve remaining weak upped interest charges via 75 foundation points, its largest unmarried fee hike due to the fact that 1994, and has signaled its dedication to containing charge pressures even supposing it brings about an increased downturn. Inflation remains rising, and which means the Fed will hike more and pass extra swiftly, to be able to place downward pressure on the financial system, so it really is including to recession fears, mentioned Seema Shah, chief strategist at Principal Global Investors. There are also growing signs and symptoms of economic weakness coming earlier than predicted. The World Bank presently expects 2022 international growth at 2.9%. Here is what some closely watched indicators are saying about recession risks. One old favorite, the U.S. Treasury yield curve, has a music file of predicting recessions, in particular while 2-year yields rise above 10-year maturities. At round 5 basis factors (BPS), the unfold between the two segments has flitted inside and outside of bad territory recently, so recession watchers are paying attention. The U.S. bond yield curve. The concern is that the Fed, facing 8% plus inflation, will take monetary coverage into what economists call restrictive territory, slowing economic activity. Chances the Fed can land on that narrow strip of secure floor are very remote, Mizuho senior economist Colin Asher said. Money markets, having slashed bets on how excessive the Fed will take hobby costs, now count on fees to fall about 20 bits per second among April and July 2023. 2. PMI problems. Purchasing Managers' Indexes (PMI) are dependable predictors of producing, services, goods inventories, new orders, and consequently future increase. A worldwide composite PMI index from J.P. Morgan (NYSE, JPM) changed into the weakest when you consider that July 2020 in May, with the new orders component solely just above the 50 stage, dividing interest expansion from contraction. PMI 20 image percent 201,656,2,596,986. PNG US PMIs too have fallen, with manufacturing decelerating sharply in June. Sub-50 readings coincided with recessions in 2008 and 2020. Global PMIs sliding in the direction of 50 is some other signal that the post-COVID increase is behind us, Mizuho's Asher said. U.S. PMI 20 image percent 201,656,004,378,870. PNG 3, counting commodities. Copper, a trendy boom bellwether, has slid 7% this week, its sharpest weekly drop for the reason that March 2020 meltdown. Dubbed drive copper due to its file as a boombust indicator, the metallic has additionally seen its price ratio to gold hit an 18-month low. In quick, if you suppose the economic system's tanking, dump copper and buy gold. Brent crude has also slid 10% in June and is set for its largest monthly fall considering that November. Copper gold 20 image percent 201,656,054,034,298. PNG 4, caring about junk corporate region strain, especially on the lower give up of the credit spectrum, is every other caution signal. Financing fees for subinvestment grade, or junk, U.S. companies have almost doubled this year to 8.51%. In euro markets, yields have soared to 6.8% from 2.8%. According to BOFA, if recession turns into a consensus view, U.S. junk bonds hazard premia could common 600,650 bits per second, and peak above 700 bits per second. At present day spreads around 500 bits per second, the index is set 70% on our way to pricing in a fact of a recessionary final results, BOFA analysts wrote. Spreads on bonds rated CCC and lower dealing with the best default chance have risen above 1000 bits per second, a massive signal of pressure. U.S. junk bonds spreads 20 bonds percent 20 June. See 2024.png5 shifting consensus. Several large banks are flagging elevated probability of recession. Goldman Sachs NYSE, GS forecasts a 30% danger of the U.S. economy tipping into recession over the subsequent year versus 15% in advance at the same time as Morgan Stanley NYSE, MS locations U.S. recession odds for the subsequent 1 year at around 35%. Citi forecasts a near 50% possibility of global recession. Citi's Economic Surprise Index, measuring the diploma to which the records is thrashing or lacking forecasts, has fallen sharply for each Europe and the United States. U.S. Euro Vicinity Marvel Index is pointing sharply decrease.